What's up, investors? Chase here from the Note MBA podcast, and it is 97 degrees outside here in Texas, which is okay because this week's show is lit. It's straight fire. We have our first ever listener call in, Iris, straight up. Your question was great, and your energy was ridiculous. And we also talk a little bit about super lien status. We talk about how to get started with JV investors, and we also cover making sure your war chest is in place, and a bunch of other stuff. Anyway, check out this week's episode right now.
Yeah, I think that's a really valuable question that everybody should be asking themselves is what's the number they're comfortable with and what's something they're shooting for?
It was actually a conversation. So we were having that conversation because you were essentially going over your first tape solo.
First, seconds, performing, non-performing? What the f***? Note buyers, when it seems like you're in this business alone, know Chase, Robert, and the rest of their tribe are at it every week. They're bringing updates from their own note businesses as they work to find, fund, and finish deals. Follow along as they share their grassroots education with you, tuition free. If you'd like to know more about what they do and to download the entire back catalog, check out NoteMBA.com. Now, here are your hosts, Chase Thompson and Robert Woods.
Hey everybody, welcome to the Note MBA podcast, your home for note investing on iTunes. I am Chase Thompson, joined today by Mr. David Glinsky. What's up, sir? How are you?
I am doing wonderful. Good morning, good afternoon, good night to anybody who is listening.
Yeah, we get the, I was listening to you guys while I was kayaking out in the bay. I was listening to you guys in my commute in the car, on the train, on the bus. We get so many wonderful listeners. Running is something that a lot of people say they do while listening to us, exercising. So
interesting.
So hi to everybody out there getting their pump on, getting their workout on. Hopefully do you need help with your sets? Do you need me to come in come in and spot for you? It'll be all good.
Yeah.
Whenever we're in town. David is a little bit more physically fit, I would say, than I am. So if you follow him on Snapchat, which you should, or Instagram, which you should, you'll see he's always working on different flips and rehabs and such. So he's swinging mallets, swinging hammers. So that's all good, man. Yeah, so how are you doing? How is business?
Business is good. I'm learning a lot more. Robbie's actually out of town. He's always out of town, but
True.
I think he's somewhere in China now.
Yes, he's over in China. He's somewhere over in Asia, and right. He actually shared a photo of an IPA that he found, in the middle of, downtown Beijing or something like that. And it was, it looked really great. It was a great little photography opportunity. I think he had multiple comments. People were like, wait, they have IPAs in Beijing? People looked like they were going to hop on a jet just to go. And I'm like, guys, you can get really good IPAs everywhere. This is crazy. But apparently that was a big deal. So that was good. But yeah, glad business is going well. On today's show, we have some good stuff. We're going to be answering some listener Q&As that have been emailed in, which is fantastic. We have our very first, technically, call-in, right? Would you call it that? You'd call it that, right? Okay, great.
Definitely call it. Well, call in / call out.
It was a calling situation. No, the other times we've had it on the show, it has been completely unprompted. Somebody, an attorney calling in, or a borrower or something like that calling in. And
to be completely honest, though, I think it started out as a phone call that kind of turned into an interview. So.
It was a great bit. I would love to get. So we'll get to it. So we're gonna just kind of tease it out. We'll put it in the middle of the show, so people gotta wait it out here. But it to me was something that I think definitely needs to become a regular thing. If people want to start sending in the questions with the phone number, and we just call them on the random, if they're available. I cannot wait to hear the feedback, right?
Maybe we could even do some Facebook Live stuff where we'll do a Facebook Live session and take questions and answers.
Send us your feedback at ask@notemba.com on what you would like considering today's call in, call out, potential Facebook Lives, different fun things like that. But without further ado, we can jump into today's show. So we've had a guy that has emailed us a couple times, different questions and comments and stuff. He's been just a really great listener and part of the audience of the show. And he sent in a couple of questions that have been ones that we've been asked before via email, and I've kind of one-off answered them and things like that. So I just basically asked him like, hey, can I put these in the show? And so that way everybody gets the answers, including you. And he was like, absolutely, that'd be fantastic. So we're going to start there and then kind of move to a couple of other things that people have brought up. So the first question he had was, he says, you both mentioned in episode 2, so he's throwing it way back, that you guys started out with JV investors to buy notes. How did you tell the investor what his or her return would be when you had never bought a note and had very limited knowledge or prior experience, aside from your origination experience? He's referring to me. Mm-hmm. And then he says, I was of the opinion until tonight that I needed to concentrate on building my portfolio using my own capital before investing with other investors' capital. So to tackle this,
I feel like I asked you a similar question maybe a couple days ago when I was analyzing that tape.
Yep.
About, I think I was asking you about how I should be making my bids, and that kind of turned into a discussion about what kind of return I want for myself and for my investors. Yeah, I think that's a really valuable question that everybody should be asking themselves as far as what's the number they're comfortable with and what's something they're shooting for. So
it was actually a conversation. So we were having that conversation because you were essentially going over your first tape solo, right? Like it was just you. Obviously, Robbie wasn't going to be answering the phone anytime soon. And so you texted me like, hey, real quick. And I was actually in the car with my wife and our kids. And so I was like, we're in traffic, whatever. I'll call him, right? As opposed to texting and being unsafe, which is something I try not to do when I'm in the car, right? So the real short answer to this is when it comes to understanding like using JV invested dollars or not using JV invested dollars and things like that, that answer is going to come from a lot of different places. So for Robbie, he had already been doing, not to obviously speak completely on his behalf, but he'd already been doing other real estate transactions before, using his own money, family money, money some of his buddies had, different things like that. So for him, as far as I understand it from all the conversations we've ever had, him getting into notes, the comfortability of accepting JV money or JV capital didn't present as much of a challenge just right off the top, right? Like if you've always been a W-2 employed individual, that can be extremely daunting. You know what I mean? Like just this notion that someone would do that can be a little crazy to be like, oh, I'm going to go ask this guy for $100,000. This is crazy. So that's something that you kind of, that's that first bar, right? That you have to jump. And he had already jumped that. I had not. The experience I had, which Ryan alludes to, is my origination experience and my understanding of both the retail side of origination and then the secondary market of origination. So understanding how those two played together, right? So I had the knowledge of how a note deal could go from a corporate perspective, right? From a bank actually owning kind of perspective, and understood how structuring real estate deals worked and all that kind of stuff. Whereas Robbie had real estate experience and had experience just taking people's money for deals that weren't note deals at the time. So there are multiple different ways that you can tackle this. The way that a lot of people do is the way that Ryan already suggests, right? They've got, say, 50, 75, 100 grand, more or less, whatever. They've got some money and they go do some deals with their money. And then they get an understanding of how this works. They get an understanding of, they maybe build a team out in an area of the country they want to be investing. They tackle it that way. The only problem with only tackling it that way, there's a couple of them, but the biggest one in my mind is, you've heard us talk about on the show before, note deals can take different amounts of time. So we have a CFD deal that we just closed out on that we want to talk about on this episode, and we'll probably get to that towards the end of the show here. It's kind of a case study on our first purchased, gone through and then exited CFD deal. That deal took 5 months. Boom, boom. Like, that's a really that's almost a fix and flip, right? Like in terms of like finding it, getting it fixed up on the market. So, I mean, like that's a really short deal in the note CFD world in terms of how quickly you can get in and out of a deal. And then we've had some deals that have gone on for 14, 18, 20 months. So the problem with just building out your own portfolio first is, in my mind, obvious right off the top, is that if I buy a deal in January of 2017, let's say I buy a small pool of 4 deals in January of 2017, and none of them are in, say, Georgia or Texas, which are real short foreclosure states. Like you've got maybe some non-judicial and judicial mix, but none of them are in super short foreclosure states.
Right.
Or maybe you have a bankruptcy and then it drags it out. But we'll just say you buy 4 deals, right, in January of earlier this year.
Mm-hmm.
It is highly likely that the soonest you're going to exit that first deal is going to be, on average, say maybe 9 or 10 months. Now, if you get into one like we did in OKC, it might be 5 months, no question, right? But that's an outlier, right? So like I'm not going to say it's going to take you 36 months, and I'm not going to say it's going to take you 5, right? Like take those 2, run them off the table, and let's talk about how traditional deals close. So between buying the deal, and then finally getting your collateral file, which say comes 4 weeks later, and then you finally make right party contact a couple weeks later, and then you're going through the process. Let's say it's 9 months before the first one closes. So it's September before you even, or kind of pushing October, before you even can go talk to anybody about your first deal closing.
Results to show.
Right. And if your first deal actually doesn't close for 12 to 14, you've now bought deals and you're doing whatever you're doing now for the next year plus, just chilling. Now, if you've got a W-2 job, let's say you've got that money, right? And you got a W-2 job, and so you're sitting and you're still doing fine, everything's good, you're an engineer or whatever, right? That might not be a bad gig. But I want you to understand that if that's the route you go, that's what you can experience, right? Like that's how that'll work. What you'll have at the end, though, is potentially however many deals you bought, 1 to whatever, right? That will be in your portfolio that you can then show off. So it's not a bad thing. I just feel like a lot of people watch an HGTV fix and flip thing, and then they hear us talk about the time it takes to do notes, but they don't ever future plan, like really throw out, cast the line, right? And like go way out and go, that's where my deal's actually going to be.
Right.
And I got to reel this thing in for 14 months.
And this is the type of thing too, which relates to, at least, I mean, you were in the real estate background as well as I. The whole of always having things in your pipeline. Like what happens if you buy it in January? You wait those 14 months, it goes swimmingly, you're happy with it. Well, now you buy, 4, 10 more. Once you exit in October, now you got to wait again, another 9, 10 months. So
yeah,
if it's, you got to do something every month to get that recurring income. If you're serious about making this a business, like you said, if you have a W-2 job and maybe you just want to dabble with it, which is totally cool. You do you. But if you're looking to making this a business, you really got a future plan as far as like every month and every month after that.
Exactly. So that's one thing to look at. The other thing to look at that we've talked about numerous times on the show is having your war chest, right? We've talked about this deal going this way or this deal going this way, or us having to shell out an extra $1,500 here, or, later in the show when we have our first call in, we'll talk about a little bit of deficiency judgment stuff where, that could be upwards of a couple grand and maybe go after someone on that end. Like just having this money aside that you're not going to go do a cash call to your investor, having that war chest to be able to exit a deal without, say, having to go back to an investor or something like that is also important, and oftentimes can be what seals the deal for getting an investor, right? Like I've had the opportunity where we're having the conversation, and part of the strength of investing with us has been, oh, and by the way, we don't do the cash call. If something comes up, that isn't in excess of X, like if we don't have to do a complete burn the thing down and rehab it, right? Essentially, we're going to handle that because we have the ability to do so. And that has turned people to go, oh, wow, that's pretty incredible. That's not what I've experienced before. I've had people come back and do a cash call on me. I've had this. So that's the other thing that becomes a problem, is you end up taking all of your money out of the game. And then, so now you have no money in the game and you have no deals to currently show anybody. And so you're just kind of chilling. So I'm not advocating 100% of saying go take money from anybody. Go make it. I'm just giving you the numbers, right? Like how it all looks. and pans out. And to the other point of his question, which was, how do you know what the return might be if you've never done a deal before? So the answer to that is an ROI calculation, right? And unfortunately, you're never going to know, right, what a deal is going to return until the deal's exited, first of all, obviously. But a good ROI calculation up front is all we can ever go off of. Regardless of if I've done 100 deals and they've all exited at 25%. That 101st deal, I could lose 50, I could lose my ass.
Mm-hmm.
So really you're never going to know, right? For sure. And it's all going to be based off an ROI calculation, whether you're doing flips or you're doing notes or you're doing stock market, right? Like it's all, like it doesn't matter, right? That's all the investing is going to be. So I would say to the ROI calculation part, and this pivots to what David was talking about when I was having the conversation with him, was I was saying, you know, he was going through a tape. He's getting ready to submit his kind of first round of bids on some deals. And I asked him, what is your minimum, like what's your floor on what you're willing to submit a bid on? Everybody's got an expectation. What's that going to be? What's the floor? Essentially saying, if I run the ROI calculation on this deal and the foreclosure scenario, which typically is the worst case, not always, but typically,
Right.
puts me at 25% ROI total. So if I've got a JV 50-50, 12.5, right? Essentially.
All right.
Do you or can you go get 12.5 money? Sure. I would like to think anybody can, right? Essentially.
That's fair enough.
Right. And so is 25, if I've got a net, expectation of say 25 is going to be what I expect this to be, is that good enough? Now, some people don't pull the trigger unless they're at like 33% because they want more. Some people can go get their money almost institutional at 6 or 4 or, whatever. So they'll pull the trigger at like 20. Because if I got to give up 6, I still get 12 and it's an infinite 12, quote unquote, or whatever. So you also have to decide where the money's coming from, how you're getting that money, what their expectations on their return is, on whether or not you can even pull the trigger on this deal or that deal, or both, or neither, right?
Exactly.
Which is, I'm assuming, the math you went and did.
Correct. Yes, it's the math I went and did. It's the math I'm still currently doing because it's, I don't know, it is a number that should be pretty easy to come up with, but I think it's that number, like how much do you want to make? Like how much do you value your time? You want to put some thought into it and really figure it out. So,
Yeah, I assume the answer is always like 16 or more.
Yeah.
So like the answer is always going to be that, right? At least, right? It's always going to be plus that, right?
And I think to add to the listener's question, it's, but as far as like serving clients in the service industry of giving returns to clients, it's all about setting expectations too. Just be honest with the client. Like, hey, this is my first deal or this is my second deal. I'm expecting anywhere from 8 to 12. I'm going to try to get you 12. I don't know how you feel about doing things like that, but I just know from my background in real estate, as far as flips and helping clients, that it's always good to set the most expectations as possible.
Yeah, you want to set the best expectations. And a lot of people, so we have people that come to us, right, to JV deal with us. Obviously, we've got the show, so they've come through that route. We've got people in our private lives, all of that kind of stuff, right? And it's always the same, right? We have them fill out the investor questionnaire and we have, we go through the paces, right? And then when we have a deal ready to go to present, we've got the ROI calculation they can take a look at, photos, BPOs or comps if they care to look at that, or just kind of take what we're saying at face value, depending on the investor. Different people are comfortable with different things, right? But essentially, they can sit and look at the numbers too. If they're savvy enough to go like, all right, well, these guys have this deal in Florida. I can see the BPO from the real estate agent says it's, worth 100. I can see that they put the acquisition here at 45. I can see, and laid out the expenses, expected expenses, right? And expected hold time in Florida is X, because that's going to be a question they're going to ask. And then they're going to either A, pull the trigger with you or not, right? Like, so a certain bit of what you're talking about, David, is just being comfortable enough explaining a deal.
Yeah, I think what it boils down to is knowing your numbers and your information and setting the expectations with the client or with the investor.
Yep.
So
That's perfect.
That's literally the two things you really have to do. Know your stuff and then explain your stuff. That's it.
Absolutely. And the last thing I'll say, because he's got another really great question below that, is when I first got in, I didn't quite know how I was going to tackle it. The way that I went and tackled it was I found somebody who wanted a certain rate of return. Let's say they wanted 12%. They're like, oh, these deals look great. I would love 12%. Okay, I'll go find you a deal that looks like that's what the return will be. And he understood the A to Y, but really wanted to understand what Z looked like. Like, what does an exit on this deal look like? So he seemed like someone who really wanted to hold on to real estate. So my thought process was, he wants 12. I'm going to go find a performing note that's going to return 14.5, 15. So I'll like pay a cell phone bill, or half a cell phone bill or whatever, right? Like I'll go pay the water bill and put him into a deal where obviously he's going to get the bulk of the money. But I knew this guy was an actual real estate investor. There was more money behind him, and it was going to be a long-term investor for me. I wasn't just taking the only 35, grand he had and just putting it into a deal or whatever. So I basically went and showed him what Z looked like. So this is what it looks like when it performs. Here you go. This is a performing note. It'll give you your 12%. Cash on cash, annualized, it'll give that to you. This is what this looks like. It's like a rental. No one's going to call you to come, fix the AC unit.
I love it. It's a way to prove yourself. And then, because like you said, it's not like the last 35 grand he had to invest, right? So,
and what's even better is now I had a deal to shop around with. Because now when I go sit down from the table, actually here's a performing note that we have. This is the end result of someone doing a modification on a deal. This is what a performing note looks like. Here's what the expected ROI on it was, and da-da-da-da. Oh, wow, that's really great. That's really proof of concept. Done deal. Boom. So, and then the next question is inevitably, well, what happens if they don't perform? But if there's no... And then it's very easy. You go, well, unfortunately in that scenario, we do either a deed in lieu, cash for keys. You're pretty familiar with that. Or we do we have to foreclose. And that scenario is pretty straightforward. We foreclose on the property. We try to do everything we can to, exit without doing that if possible. But if we have to, we do that. And then it becomes, an REO and or it gets bought at auction or, something happens, and then explaining that exit is very obvious. Like it's really easy for them to wrap their head around. We foreclosed, we got the property back, then we sold it. That's, it's a very cut and dry explanation there. Oh, okay, great. Okay, cool. Done. So that was the way I accomplished my getting over the hump of asking someone for money, getting them comfortable in this business to be able to invest with me, and getting a deal I could shop around with. So.
Love it, man.
It worked for me. His next question is really great too. So he says, my second question is what happens when you commit? So we're already going to dissect this one. What happens when you commit to a certain rate of return for your investor, but you don't earn it due to unexpected expenses or longer foreclosure hold times? Does this come out of your pocket? Do you take less of a split in profits to ensure the return forecasted at acquisition? How do you handle these potential sticky situations? Do you want me to just jump in on this one?
Feel free to. I just think I think what really it comes down to is how much you want this investor to invest with you again. I mean, I know some people that would be like, no, I want my share of the money and that's what I'm going to have. But then again, my perspective, which I believe is Robbie's too, is that if things are going wrong, I'm going to take a cut, make the investor happy so they invest with me again in the future, to show them that you're admirable and that there was something that went wrong and, you're going to step up to the plate.
Ultimately, you can have two different perspectives, right? You can have the stock market, investment banker perspective, which is, sorry, didn't go as well as we planned. I'll catch you on the other side, right? Or you can do it the way that we've done it on numerous different deals that have gone that route. So the first thing I'd like to tackle, though, is this committed to certain return. That's like almost guarantee language, which you would never do.
Right.
So right off the top, if David, here's this deal we're going to do. Here's my, ROI calculations. Here's what values. Here's what our acquisition is. Here's what our expectations are. All of that kind of stuff. Okay, great. Let's do this. Right.
Mm-hmm.
And then unexpected expenses, S hits the F, whatever happens, right? And it comes down to where we're $1,000 over acquisition at exit. Like it absolutely did not even return anything worth anything. I'm going to have the conversation with him. I probably have already had numerous conversations with him throughout, but it's likely we'll obviously have the conversation at the end, which is, here's what's happened. Boom, 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 boom. I've got all your money ready to go into another deal if you'd like. This one didn't go as well as we'd like, but obviously your investment principal was protected. Here we go. Move on down the line. If you wanted to split the 1,000, if you wanted to use the 1,000 to cover some expenses you used, whatever the case may be, you can have that conversation. Now, let's say, it ended up returning 16% and you were expecting 26. Well, in that case, I'm probably going to cut the investor 12 and I'll take 4 or something like that. Mm-hmm. It really depends on the scenario and obviously what expectations you set up front. But traditionally, yeah, we're going to take the cut. We're going to take the haircut. It's the classic, the Tom Brady, the Tim Duncan of the Spurs. It's the I'll take a pay cut so the team stays together.
Yeah, it's the two in the, what is it? 2 in the bush or 1 in the hand? Is that right?
You and euphemisms are hilarious. Not euphemisms. Wait, euphemisms? That's not a euphemism. Anyway, yeah, 1 in the hand, 2 in the bush, essentially, right?
Right. Yeah.
That's exactly accurate. Really all it is it's reputation, respect, trust, integrity, right? It just all transparency. It just kind of comes all down to that. And there isn't likely to be a scenario where it's ever going to be a long-term gain for you to take the short-term, leg up, right? Mm-hmm. Because ultimately this person's going to go and tell other people, or they won't invest with you again, or it's just, you're always going to know. And depending on the situation, it can get very hairy, but most of the time, that's how I would expect it to go. So number 1, commit to a certain return is almost a guarantee type of language. So already I would obviously steer clear of that.
Yeah, don't do that.
Here's the expectation, right? Here's what the expected return would be based off of all the numbers being as true as we can possibly make them, right?
Right.
And then the deal runs its course. And if something like that comes up, or you got the expectations and whatever, you assess at the time, but more than likely you'll be the one to kind of take the haircut. I would assume.
And honestly, the investor shouldn't even, and this is a generalization, they really shouldn't be that upset, because if you're doing it the right way, you should be having communications and, the whole way through, you should be letting them know, like, yeah, things are not turning out how they were supposed to. Things might not turn out the way they're supposed to at the end. You should just know this. That way, no surprises. Nobody's like super upset at the end when they don't get their expected return. So
right, yeah, no, I totally agree. So from here, we're going to pivot to what has been dubbed the first call-in, though technically, thanks, David, it was actually a call out, but the question came in first, so we're just going to, essentially what we had we had a listener of the show send us a question over at ask@notemba.com, and it had so many interesting moving parts, and I wanted to know her side of the deal before I really tackled an answer, and the answer was going to have some length to it, depending on which side of the deal she was potentially on, and these types of things. So answering it via email was going to be tough. So I just said, hey, why don't you toss me your phone number and we can talk about where you're at in the scenario. And then we just kind of turned it into a call-in bit. We asked her if we could include it on the show, obviously. She said, sure. So without further ado, here is Iris from NT Capital as our first I'm going to call it technical call-in on the show.
Hello, this is Iris.
Hi, Iris. This is Chase. How are you?
Hey, good. How are you?
I am delightful. I wanted to call you about your email, and I wanted to include this as a part of the show because I thought it would be an interesting answer to, because I think I have an understanding of the question you're asking, and I want to make sure that I have a proper understanding of what you're asking, and had some additional questions for you that I thought would be interesting, like I said, to include on the show if it was what I thought it was. So is that all cool?
Yeah, totally.
Fantastic. Okay, so you sent in an email, right, regarding, number one, you said it was great to meet us at PaperSource. I agree. It was fantastic meeting everybody. It was so great. But you had asked a question here, and I wanted to make sure I understood the question because there's a lot of moving parts. And I wanted to know if this was like a deal you were in now, and if so, like how did you get into it or whatever. So if you want, I can run through the question via email, or you can kind of like pose the question, just straight up. What would you like? How would you like that to happen?
Well, so I'm actually on the other side right now, but I was listening to you and Robbie, because Robbie seems to have encountered this issue multiple times, and he's mentioned that sometimes he pursues the deficiency judgment and sometimes he doesn't, right? But he goes generally after the borrower. Well, what about the person that, isn't the borrower, the other person, like the other person who buys the HOA lien? Or like an example of maybe a tax lien, it's actually all in the same category. So there's some vagueness on which one has priority. Like, so is it above the first, or is it below the first, or is it subject to the first? The laws are very vague about this. And so that's why I was wondering, what is you guys' experience with deficiency judgments and things like that?
Yeah. So so we'll dive in on this. So basically based off of your question here via the scenario, right, that it was laid out was the borrower has defaulted on the first and defaulted on the HOA dues, right? So the HOA has foreclosed on the property and sold it to a new owner. Okay. So we're setting the stage. We're done. Now, before I move on to the question, where are you in this deal? Did you buy this defaulted first?
No, I actually bought the HOA lien. So I'm on the other side.
Okay. So you bought...
But it would still apply. Somebody else has the first.
Oh, I see what you're saying. Oh.
Yeah.
Okay, so your question...
I'm on the other side.
I got you. Okay.
But it still applies because now I'm trying to figure out what is the first is going to try to do.
This is in Nevada, though, which is a super lien state, which means now that the HOA has foreclosed, they have essentially, they've wiped everybody out. So this is what, the person that had that first lien, that was in that first lien position, essentially the HOA by foreclosing wiped everything out as if, say, you had a second and then the first had closed, right? It's essentially, if you're trying to think of like a framework, right, for how this actually looks. So technically the person that had that first has now been wiped, right? And the debt is still owed, right? Because like the mortgage and the note, those are two different things, right? Debt is still owed, but it is now unsecured.
I see. Can't go after the property. The first cannot go after the property, but they can go after the borrower.
Yes. So the person in the first lien position in this case that has now been basically foreclosed on out of, this deal still has debt owed, right? And so now they can do things like when we had Franco Borelli on the show a couple of weeks ago, where he was talking about how when someone's in second position and they get foreclosed out, there's still options, right? Because the debt is still debt, except now it's unsecured. And so you obviously are in a, you don't have as much leverage, obviously, right? But you potentially still have options and things. You're just in, and potentially, obviously, because it's a first as opposed to a second, you obviously probably, not you, but the person that had it paid more, right? Traditionally you're going to pay more as far as percentage of owed and what have you. So now they essentially have a high value or high paid out, to acquire unsecured debt that this other person really, they're obligated to pay, but like if they do a bankruptcy, like there's all kinds of ways that now, because this is a straight up unsecured debt now.
Right, and the borrower, as I have found out, is actually resides in Northern California, and I don't know what his asset situation is like, but I don't have any dealings with him because I bought the lien, so it doesn't matter. I'm not going after the borrower.
Yeah, right. Exactly. So my concern, and the reason why I wanted to, because the way you asked the question was so great, but it just opened up so many more questions, right? Because I was worried, say you bought a first that you didn't know, right? And then you got foreclosed out, and I was like, oh man, I gotta know where she's at on this one. So congrats, right? That you're on the better side of the deal, I guess, right?
I'm not in a better position, by the way, but go ahead and ask your questions, and I.
So what is the position you're in now? What do you mean you're not in a better position?
According to all the research I've done, there's a lot of new, articles online about this specific situation, and it's a super lien state, like you said. However, the federal court and the state court are not. They're ruling differently in terms of when, and every single individual has to go to court. It's every case. They're not doing an umbrella case. So on the surface, it says that it's a super priority lien and it wipes out first. That's what the legislature says is how it works. But they've taken it up to federal court, and the federal court has ruled against, basically in favor of the first in some instances.
What's the precedent? Like, what's the or in those rulings? Are you familiar with what caused that particular ruling? Like, was there a situation of you know what I mean? Like, was there any similarities between the ones that got decided that like, oh well, we know you're a super lien state, but oh well.
Right. So the first is arguing that they needed to opt in for the notice of foreclosure, meaning that the HOA had sent letters, certified mail to the first, but the first didn't respond. And the first says, well, we get so many mails in a day, well, we can't respond to that, so we need to opt in for. So that's where the point of contention is that, well, we were notified, well, you were, but you didn't check your mail. So that's kind of where it's at right now. So it's very fuzzy. There's really vagueness. But what I wanted to ask you guys was, with Robbie, in the event that everybody goes to court, the first goes after the new owner, or the new owner goes after the first, and the first is, wins, right, or whatever, in the instances that they said proper due notice was not served, then can the first go after the new owner for deficiency judgment? That's really the question.
No, I don't see how they could. I don't see how they would. Again, with the mortgage note, all that kind of stuff being separate, the money owed would still go, as far as I would understand it, would still go all the way back to your guy living out in Northern California, because that's, the name on the doc that was signed on the line, you know what I mean? The real weird spot in this scenario, obviously, would now be yours. Because if it went back to the first and they said, oh, well, in your case, the notice was served, but there was no response, they didn't opt in, yada, yada, you now think you've got a deal, but you don't have a deal. Is that what I'm understanding as well could possibly happen?
Yeah, exactly.
So I personally would love you to keep me updated on this deal. And I hope, obviously, that it comes out really well for you. Can you give me any of the numbers on the deal? Do you know any off the top of your head?
Yeah. So when I bought it, it was like 2 years ago. I've been sitting on it for a while.
Okay, wow. Yeah.
I bought it. Yeah. I bought it in actually, it's now been more than 2 years. I bought it in January. Well, I bought multiple. But the first one was January of 2015. So, because by then, prices have already gone up in real estate, and I was trying to find deals, and this one was pretty good. So at that time, I paid about 45 cents on the dollar at that time. Now the prices have gone up, so right now it's about 30 cents a dollar.
Oh, wow.
Yeah.
But you've still been sitting on it.
Too much.
Yeah.
I still pay too much because
Yeah.
the HOA outstanding was, like you said, $5,000, maybe even with attorney fees or whatever. But the law says you can only collect up to 9 months past the previous 9 months. You guys all know this. So then after it's paid, then the debt collector took the difference. So the HOA got paid their $5,000. And then whatever extra I paid for it went to the debt collection company, right?
Mm-hmm.
And it never paid. Supposedly, it's supposed to pay the first, right? Whatever's remaining after the $5,000 goes to the first. Well, the first never got paid, and so that was really interesting because I was under the assumption that the first got paid some money from whatever I got, but the debt collection company who did the foreclosure auction, it's a law office, did all of that. They took the money, all of it. But yeah, so it gets a little interesting, and it's a huge problem right now in Nevada. I don't know if it's the same thing in Florida. I did read something about Florida, but I don't know if it's messy, and so everybody's duking it out, and so 2 years I've been sitting on it, and I obviously renting the ones out, and I lived in one for a while, and then now I'm renting all of them out and collecting rent. Right, rent is still mine because technically on paper I have the deed wrote over to me, right? So technically I have the deed. So I've been sitting in the house and the bank hasn't been doing anything. And recently, I think because prices have gone up, the first wants to collect their debt, like they want to collect. So the way it does it is either the new owner, me, sues the first to get quiet title, or the first goes after the new owner, which is me, or either I sue them or they sue me, basically.
Wow. Yeah.
Yeah, and every case, I can't sell the house right now because unless somebody, I can't put it on MLS. No, normal process. Yeah, so because they're still technically on title, and I have to pay an attorney to remove them off of title, and so it's they call it a quiet title lawsuit, and the price tag is kind of high. It's anywhere between, on the low side, if everything goes smoothly, $3,000 up to, God knows, 10.
Oh, and the whole thing might not work.
Yeah, so apparently I'm just a small fish in the ocean. There are two very large, investment companies that bought thousands and thousands and thousands of these in the years 2013 up to 2015, whatever.
Mm-hmm.
And they're taking it up from state court into federal court, and federal court up to the Federal Court of Appeals, the Ninth Circuit, and then up to now they are petitioning to the Supreme Court for an umbrella ruling.
Okay, well, I appreciate you letting us include this on the show. One. Two, I would love an update on how long. Real quick before you get off, how long have you been investing in liens, notes, different things like that?
Well, notes and stuff is just recently, actually. But for real estate, I've been doing real estate for a long time. It's just this notes thing is kind of new to me because I didn't know anything about it until recently, and so. I'll send you the Supreme Court rulings and things like that. And there's no ruling. The Supreme Court petition that just went up. But the Supreme Court of Nevada ruled in favor in 2013 or 14 is when they ruled in favor of the HOA, meaning officially signing into a super priority.
Yeah, so they basically said
distinguishes the first.
Yeah, this is what we want here. And we're going to uphold it here, essentially. Definitely send that over because I'll include that in the show notes. I'll send that over I'll put that in the show notes for everybody.
Awesome.
Thank you so much.
I can't wait to hear it.
Cool. Thank you so much. Have a wonderful day. All right, Mr. Glinsky, thoughts?
That was great. I think it was really interesting how she's not actually doing a note. Correct me if I'm wrong. She's doing HOA liens, right?
So kind of got the understanding from her. She's been doing real estate for a long time. She's, just now getting into notes. She was doing, I know a lot of people that have done tax and HOA lien stuff without being in notes and things. So this looks like something, because she said she bought it, I believe, in January of 2015. So this is something that she had done, it sounds like, prior to even getting into understanding the note space. So she was already doing this kind of stuff. Yeah.
Which is awesome, yeah. And I've run into the situation before where I've tried to buy just a regular house on the market to flip, and I ran into the HOA actually foreclosing on the house before I got to buy it, and they started renting the units, which I thought was a wonderful idea, because if you could pick up an HOA lien for a couple of grand and rent the house until the first forecloses, you could potentially make a good bit of money renting the house out. So I liked her idea.
Yeah, it works out. And so essentially what she had was is intricate. Obviously, she's had a ton of great research done, conversations had, different attorneys, different things like that, with understanding regarding the super lien status of a state and of deals. And she actually shared a link. She sent me a link to I believe she said it was the Nevada Supreme Court decision on how they saw super lien and all of this kind of business. So we're actually going to link up the some information that she sent over from us in the show notes over at notemba.com for you guys to kind of check this out. Fascinating. Essentially what David referenced it, saying started out as like a call-in Q&A bit that turned into kind of an interview that turned into like a ton of really great nuggets and information. Just a fantastic bit. I appreciate it very much, Iris. And it took, only 100 and almost 30 episodes, right, to have our kind of first true call-in from listener type situation, as opposed to like random attorney and or borrower or whatever we've had on the show before. But no, it's a fascinating understanding and look at a different way of, tackling the business. Obviously, going out there and investing in HOA liens is not something that's new. Tax liens is not something that's new. But understanding more about that business by understanding this business, which I thought was fascinating.
No, it was super fascinating. Now, do you mind explaining a little bit about what a super lien state is to maybe the people that are listening that are newer?
So a super lien is so first of all, we have a really great episode on super liens already. It is episode 90. We talked about super liens and I believe Ohio's dollar deed program and a mastermind that we had been to and just a bunch of different stuff. Episode 90. If you have not already, definitely go check that out. We will link it up in the show notes. But essentially, on that episode, we actually talked about how Nevada was no longer a super lien state based off some legislation that had come down. However, this particular deal that she bought 2 years ago might be a grandfathered in situation, but then she just linked up and sent us that article that came from the Supreme Court of Nevada that basically says, yes, we are a super lien state. So a lot of what she talked about, without talking about it, though she said it a couple times within that call-in, was just the general convolution of the super lien status, what that means, what that doesn't mean, and how it actually works within the state, specifically of Nevada, but in general, is ripe. There's a ton of just convolution regarding it all. So that as a, to supersede the discussion of what a super lien is, that is some information for you. Go check out episode 90. Here we go. So essentially what a super lien is that if you were no longer paying on your HOA, they had the ability to supersede the first and foreclose on you and essentially make your first, if you had the first, whoever that was, whether it was a bank, you, whatever, you're now subject to the new lien holder, which is now obviously the HOA, right? You are now in second status essentially of what you would traditionally expect to have if you're thinking about it as a traditional mortgage. You have your first lien, your second lien. That is now you as the first lien holder, which is obviously something not a lot of people who buy first would be like, oh gosh, that's crazy. I wouldn't think of that, right? So Florida and obviously Nevada, though, again, we mentioned in episode 90, it didn't look like they were anymore. Now it looks like there might be some, obviously, more convolution to it. Those are two of the big kind of super lien states that we've talked about before because we've invested in those two states. But that's essentially what it is. It's as simple as it sounds. They have the ability to super lien all of the other liens potentially on except for obviously anything owed, I assume governmental taxes, things like that, to be able to foreclose and then take possession and start presumably renting, like you mentioned, getting those types of scenarios going. So that's what that is. I'm fascinated by the fact, as I revisit episode 90's, show notes and that show in general, about the fact that we already talked about the fact that Nevada was no longer a super lien state. And yet she's providing this document. I am floored. This is what makes real estate so fun. This is what fun and not fun, depending on the side of the deal you can be on and other things. But that is, generally speaking, extremely fascinating to me. So we will include all of this in the show notes. NoteMBA.com.
I'm excited for her to follow up too.
We asked her to follow up, and I, just like you, I am pumped. Number one, because her energy was fantastic. I definitely think any follow up needs to be done on the show, not in email format. But I would love to see how this turns out. And my biggest issue with the deal was I didn't know what side of it she was on. So I was concerned that she had bought the first and then had been foreclosed on unawares or something, which would have been obviously terrible. So very excited to see how that one all shakes out. The last thing on today's show is, well, here we go. David, you get to direct the show here. Do you want to sandbag CFD talk for next episode? Because this is already an extremely long episode. So we can sandbag CFD for next time. Okay. And you can hit me with what's going on with you, your experience with your first bit of due diligence. We can sandbag that for next. Where do you want to go?
Honestly, I feel like it's a pretty good show so far, especially with the conversation we had earlier.
Yeah.
I do want to talk about me, and as much as I want to be narcissistic and be like, oh, listen to my deal talk, but no, I think it's a lot to digest already, especially with that call-in.
Well, so here's the thing. So here's what we will do then. Next week, we've got CFD talk. It'll be our first kind of purchased, run through, and then exited contract for deed deal. We'll talk all about that out of OKC. So we'll cover that. And then hopefully, by the time we come around to next week's recording, David will have not only gone through his first time of due diligence going through a tape, hopefully he will find some stuff that is worth bidding on. He will bid, and we will have what happened, essentially. Does that work for you?
The cliffhanger show this week. The first cliffhanger show and call-in. That's the...
Is it the first? I don't know. Anyway, thank you so much, David. A huge shout out to Iris for being our first call-in. Thank you so much. It was fantastic. Your energy was contagious, and it just was wonderful. So thank you for that. As always, if this is your first time here, be sure to head over to iTunes, give us a rating, give us a review, and of course, subscribe. It helps us out tremendously within the iTunes environment. Anything that we've talked about, including the stuff from the Nevada Supreme Court, obviously the show 90 that we've got, all of that stuff will be linked up in the show notes over at NoteMBA.com. This will be episode 129, so go check that out. And as always, be sure to tell 5 other people this week about the Note MBA podcast. Catch you guys next week.
Thanks, everybody.